Now we have a lot to talk about with Europe. There was a lot of information to come through that was disseminated, and we'll try to take it through different pieces because there's two sides to European data right now. There's the side of, well, the data's gotten better, which is clear when you look at from February to March. But now we have additional lockdowns. We have some of their trade partners struggling. So what does this look like in general? And there will be some reverse, but it just won't be as steep as I think I initially thought. Some of the estimates abroad that, people were very lofty, those are coming down. But while they're coming down, I think we have to get a bit more positive, especially when we look at some of the data sets here. So just looking at consumer confidence. So the consumers, obviously feeling a bit better. This is looking at March. It'll take a hit with the extension of lockdowns. But again, people are past it. People are we already showed in the EIA show that, 2 weeks ago, we started seeing slowdown in travel and mobility. So whether it's a national lockdown, not a national lockdown, people will just do less, and they have been. So there's a certain amount of that was also baked in the March numbers. So that's why we should see some of this confidence in general, but when we look at services confidence, that's starting to get a little bit better. But then when we look at CPI, obviously CPI was slightly better than expectations, but clearly positive. So when we start looking at this positivity or the positive move, as we showed in segments 1 and 2, when we looked abroad to look at those pressures, when you look at the distance between obviously prices paid versus prices received, and then additional in terms of just the delay in movements, that's where we're continuing to see some of these pressures in general. Now, when we look at specific things like Spain, when we start talking about Italy, so Italy was right in line, getting a little bit better, which is a positive. When we look at retail sales, they're starting to pick up a little bit. Those are the things that continue to be a net benefit. But then when we look at import price index, so just taking this from the perspective of Germany, so import price index was expected to be at 1.3% in February. It was at 1.7%. Year over year was supposed to be at 1.1%, came in at 1.4%. This is the front end of inflation. When you import it, because it's also, Germany is a net exporting nation, that means their export prices are going to go up. And that's where we continue to see kind of that bifurcation in terms of what is being accepted in the market. CPI went up a wide amount in Spain. That's going to become the kind of that growing trend. While retail sales were expected to be down 6.2%. They were down 5.9%. Again, Spain remains to be one of those, I think, one of the growing sides of where this is going to go over the near term in general in terms of some of that resiliency. France, something similar. So now the question is going to be, okay, well, we looked at the aggregate. Well, let's take it into pieces now. So let's look at what is happening with the Eurozone inflation, which rose that sharp spike. So fitted Eurozone inflation, all items, Eurozone inflation, all items year over year. We're gonna get that next leg up, which is something that the ECB is going to look at because they want to try to manage rates even as inflation is going up, which is why we're starting to see them get a bit more active on what they're purchasing, which is why we've actually seen another leg up in the amount of ECB stimulus. But then when we look at Germany, so the significantly higher prices were for heating oil and fuels. Again, and crude is still at $60, especially Brent when you look at it coming at 63, 64 in general. This is driving things higher. Now, when we talk about grains and we talk about the shift up where, U.S. is limit up grains, like this is a big problem when we're looking at general pricing, especially as not only on things that were deflationary for so long, when you go through that dip period, now we're starting to get the base effect, but also some growth on the back end of it. So when you look at, okay, well, how normal can things get in Europe? Europeans now see AstraZeneca vaccine as unsafe. And no matter what you can do, the popular perception has shifted. And this is something when you look at AstraZeneca, and even if it's available, you're already looking at there are people that will not get it anymore that were already on the fence and now definitely not. So now when you look at Germany, France, Italy, Spain, they're going to wait for Pfizer and Moderna, which is just going to limit how quickly we can get some of these individuals vaccinated. And this is, again, going to cap how quickly we see some of this resiliency and redundancy in the system as we see cases that are continuing to rise. And not only is this going to be an issue for the local economy, but what does it mean for travelers? What are people going to do? Or would you go to France or would you go to Paris if things are closed, or you're not sure what's going to be open and closed, or, this is where you're looking from the US into France, or from people going from Italy to France, or Italy to Belgium. The travel is going to be that headwind. So travel experts around the world are expecting a difficult recovery, with really not seeing some of this normalization into 2022. But realistically, when we look further out, when do you expect international tourism to return to pre-pandemic levels? It's getting much closer to 2023 and beyond, which is just going to put more pressure on some of the issues in general when we're looking at, what happens next? So then when we look at tourism, what does tourism mean for the local economy? And this is why we talk so much about Spain, because Spain not only has the biggest exposure to Turkey, but they also have the biggest exposure to net tourism. So net tourism is going to be that headwind when we continue to see just the damage. So Germany had some benefits in terms of when things were in Q4. But when we start looking at household consumption, tourism, investment, housing, you can see Italy and Spain continue to lag behind. And that's something that is not going away anytime soon, which is, again, going to lead into, while we've been very bearish Europe, and I think rightfully so, but it's just now we have to start getting a bit more pragmatic about, numbers are getting a little bit better, so some of this is going to reverse, but it's not going to be everybody. And Spain and Italy continue to be the big anchors in terms of how quickly we can get some of that European recovery. So then when we look at the Eurozone debt on non-financial companies, so company debt soared in its first 9 months of 2020. And I think it's important to look at France, because France was what needed a huge increase in debt to stabilize and essentially secure some of their their underlying businesses. And you can see it was pretty much the Euro area saw about 9%, not to 10%. But when you look at France, they were at 24%. So you're seeing this big shift, with more coming from Italy over, based on what's been announced, and then Germany as well. So again, this is seeing this push higher in terms of the debt-laden nature of companies that were already struggling under a significant amount of debt. Now, when we look at the ECB balance sheet, you can see that next leg up because it took another leg higher. So now total assets rose. So they increased by 343 billion euro, which is the biggest amount since June 2020, as banks took 315 billion in TLTRO loans, and ECB kept buying more bonds to try to slow down that increase in long-term bonds. So the ECB balance sheet is now over 7.5 trillion, which is equal to 75% of the Eurozone GDP. Now, broken out, you can see that Italy is at 170%, or it should be at 170% quickly. The early estimates are 167% based on what Draghi is looking to do. So then when we look at what is being added, so it's important to understand what has changed at the ECB. So the ECB legal decision on the PEPP is big. 33%, the 33% issuer limit will not apply to emergency asset purchases. The ECB will target shorter maturities, a minimum of 70 days, in the hope that PEPP remains temporary. So there's no more limits on ECB QE. As you can see, that PEPP has really accelerated, and that has been the biggest method that they've used to try to get and try to cap some of this increase in rates that we've seen over the last few months. So then, I should say the last month and a half. So then the most crucial part of the decision was to account separately for PEPP purchases, which are not included in the PSPP 33% issuer limits. Otherwise, we would be above 33% in a number of countries already and counting. And again, that leads back to Germany, who's the one counting. The ECB's PEPP announcement was bold, and it became legal, and Act made this commitment credible and in practice on March 25th. So when you think about when does the accelerate really happen, you can see that it had already happened, and then they retroactively made it legal. So here's where you can see just what that pain looks like and what is that going to drive going forward. But then when we look at what happened in Germany, so when we look at what happened in Germany, you can see that things have gotten better across the board. When we look at going into the future, going backwards. So when we look at current business climate, the current business climate is getting better. All of this is moving in the right direction. The question is going to be, what does trade do? And do we get any type of limitation because of a renewed lockdown, not only impacting some of their exports, but also impacting some of their internal mobilities? Easter is always a fairly slow period, specifically in Europe. So some of that will come into the numbers, but you can see that there is a general better business view, and Germany is still that growth engine within Europe. So if this is the case, we should see some support. Even though we have some COVID reductions, we'll still see some report on the economic side, while we'll see some of that capping on the gasoline demand side. And this just puts it into perspective in terms of, the business expectations are back to the highs from 2018. German account assessment, and in terms of just business climate, are all moving in the right position. But if you think about just the ease of transactions, the ease of liquidity, it makes sense to see some of this positivity moving into the system. Then when you start looking at, let's look at PMI. So input prices, supplier delivery times inverted, you can see that the costs are going to continue to go up. And this is where we start to get a pause as to when does the market reject? When does Europe or Germany's exports become too expensive, or you have to start to mitigate some of the purchases to try to offset some of the rising costs? This is some of that friction that we continue to talk about and we continue to see. Now it's starting to appear more in Europe. So then when we look at Eurozone loans to households, they've been fairly flat. But when you look at Eurozone loans to businesses year over year, they remain elevated. So when you're thinking about business conditions and the business opportunities, there's still ease of getting money. There's been some tightness, but it's still easy to get loans, to get and hit the market, which is a net benefit for keeping some of these businesses active. But when we start breaking it down in terms of, how bad or what is some of the impacts of inflation? Well, let's look at the composition across the European area in terms of consumption. So when we start looking at household and utility services is the largest on the services side, and then non-durable goods, it's food at home. So food, we keep talking about just going higher, and then as we've been talking about in general, housing continues to get more expensive. So realistically, almost what is that? That is 39%. So almost 40% of total consumption is food and household. So as these prices continue to go up, as food prices continue to shift higher, this is where we continue to see these pressures. And then when we look at just food services and accommodations, recreational, all of these services are fairly cheap. But when we look at durable goods, that's where we continue to see those pressures going up. So the non-durable, durable, and housing service side is going to be some of these drivers for that household pressure. Then when we look at, this is just looking at German CPI in general, which is at that 1.7%. So you can see that strong bounce. The ECB is going to do what it can to try to cap it at these levels because it really can't see it go too much higher. But when you look at the pressure they're facing, when we're looking at, service input prices, when we're looking at delivery time problems, this is where we're going to start to see them try to come and try to battle to keep some of these rates compressed. Then when we look at Italy's growing debt, this is where we start getting to that 160% of GDP as the lockdowns are boosting that need for borrowing. So Italy's budget deficit is likely to be close to 10% of gross domestic product, which is a boost from the initial, which was supposed to be 7%. So, and this is when we can do it. So I'll give you some numbers and some data sets for this. So when we look at it, at the time, officials anticipated the deficit at 7% this year, with the debt ratio nearing 156%. The forecast will also show the economy growing only 4.1% this year, compared with a prior outlook for 6% expansion and then 4.3% in 2022. So 2021 is going to be 4.1%, 2022 4.3%, which is why, again, we think that we're going to get much closer to the 160% of debt to GDP, which is just that overhang that we continue to see within Europe. And you can see that they've really haven't been able to do much to take it out since the financial crisis, which has continued to push things higher. So this is, some of that backdrop for Europe. In the next segment, we're going to look at Asia, because a lot of the same issues that are impacting the U.S. and now Europe are very much so hitting the Asian economy. And a lot of this is the emerging market, which is, again, putting additional pressure in different ways on how are they going to try to mitigate some of the issues, and just what is that borrowing going to look like as rates continue higher around the world.